One of the features of the sell-off in stocks yesterday was, and we're told, everyone was concerned around inflation. Break-evens reacted as if everyone was concerned around inflation. And yet the US 10-year yield didn't really move much. It went over 1.6 this morning, 1.6%. But it didn't really participate all that much in that sell-off in stocks that we were seeing yesterday. Is that because people are not joining the same dots between higher inflation and Fed response as they might previously? Because the Fed has said many times they want to see progress on the unemployment front.
Yeah, excellent point, Anna. It's like you read my mind. I was just looking at the same thing. There's all these headlines about inflation fears, whereas the 10-year yields hardly budged on a nominal basis. And I think this is the power. This is the power of the central banks anchoring those real rates. What I would highlight, though, is your point about the equity market concern, especially these longer duration equity markets that are, the tech sector being a key example here. There is more vulnerability in that space relative, I would say, to the bond market, because the central bank can clearly affect the bond market directly. But what I would highlight and caution against is turning very negative on the tech sector, especially in the US. We've seen very strong earnings, and actually positively surprised by the resilience of earnings in Q1. When we think about the earnings potential over the next 24 to 2 to 3 year period, we're still very positive on that secular story in tech. So yes, we're going through a period of recalibration at the moment, but we would not, we'd caution against getting too negative or pessimistic right now.